A pioneer in public finance since 1955, Ellers helps clients build outstanding places to live, work, learn, and play by delivering focused, fully integrated financial advisory services. We work with more than 1,500 local governments, schools, development authorities, and public agencies, placing their needs and best interests at the heart of everything we do. We help our clients navigate all facets of public finance, including financial management planning, economic development and redevelopment, debt issuance and management, investments and treasury management, and arbitrage consulting. At Ellers, we believe strong communities aren't simply the result of transactions. They're the result of people. We build strong, long-lasting client relationships, collaborating with your staff to complete projects and drive new initiatives forward. Building strong, vibrant, and sustainable communities. Together, it's what we do. For more information, call us at 1-800-552-1171 or visit ellers-inc.com.
Good morning, everyone. Thank you for joining us today for Ellers' virtual session to discuss tax increment strategies. I'm Todd Tate, Senior Municipal Advisor with Ellers, and I'll be serving as your moderator today. Before I introduce my colleagues, I have 3 housekeeping items to mention. You'll notice in the upper right-hand corner of your screen there are 2 icons. One is called Live Q&A, and the other is Chat. If you have a question you'd like us to answer as we move through today's presentation, simply open the Q&A tab, type in your question, and hit Submit. At the end of the session, we will have time to answer submitted questions. You can also have conversations throughout the session with fellow attendees by using the chat function. While you can submit any question anonymously, we recommend you allow us to see your information so that in the event we're not able to get to all questions today, we can reach out to you directly. Lastly, if at any point during our presentation you notice either video or audio lag, please try refreshing your browser. Now that we've covered those items, let's go ahead and get started. I'd like to introduce my colleagues, Sean Lentz, Senior Municipal Advisor, and Josh Lowe, Municipal Advisor with Ellers. Take it away, Sean.
Great, thank you, Todd, and good morning to everyone participating in today's session. To start out, before turning it over to Josh to go through the agenda, a couple things I wanted to mention to our attendees. Really, the background for this session came out of the struggles that communities are facing in dealing and trying to find ways to take on their challenges and find a way to pay for those challenges. And as we've struggled along with our clients in achieving those goals, the broader and more creative use of tax increment has been one of the primary tools in making things happen and moving toward communities' goals. So as we go through the session, keep that in mind as kind of the background of why we put this together today. And at this point, to start out the first half of our presentation, I'll turn it over to Josh to go through the agenda and to start us off. Thank you.
All right, welcome everyone. Today we're going to cut the session into 2 halves. So to start off, I'll be talking about the 12% limit, which guides the creation of new tax increment districts. And then I'll hand it over to Sean to talk about how you can maximize your existing tax increment district and make sure it's successful. All right, so the first thing about creating a new tax increment district is the 12% test that we want to cover. And that's a guideline that the state provides to ensure that not too much of your overall fiscal strategy is tied up into tax increment districts relative to the overall size of your community. So the way the 12% test works is that no more than 12% of your town's total equalized value should be captured in tax increment districts. And so just to think about that for a minute, you might want to think about, like, why do we even have that? Why should we be limited? And why does the state care how many tax increment districts we have? And so when you think about what the purpose is of a tax increment district, it's to really funnel new revenues into those districts to pay for projects in those areas, and it doesn't go to your general fund. So if there's too much revenue captured only in tax increment districts, you don't have enough that's going to be left over to fund all the other things that need to be done in your community. All the rest of your operating costs related to, staffing for police or fire, or other capital projects in the rest of your community. So the 12% test is really a way to force you to think about the overall health and fiscal health of your community. So you're not putting too many eggs into that one basket. All right, so this is just a quick sample test of how you go about applying the 12% test for creating a new tax increment. So you can imagine if your overall equalized value of your community is $100 million, 12% of that is $12 million. And that's really as much as you should be having in your tax increment districts. So if your current increment value of your existing TIDs is 11 million, then that means that any new district needs to be less than 1 million in value of its current base value. So in the example you can see on your screen, if you have a new district you're trying to create of 900,000, then you would pass, and that would be fine. So another question, a way to think about this 12% test is if you are lucky enough to have potentially 2 new districts that you want to create at the same time because there are 2 viable new projects, and let's say just for example, they're both over 900,000. In this case, you could actually pass both of them at the same time. And the reason for that is because the Department of Revenues applies the test to each new district individually. They don't add the 2 together for you, understanding the logical. Pass both of them at the same time, you'll be eventually above the 12% test. That's, of course, the way that it would work to gather them both together. But fortunately, the DOR gives you a little bit of flexibility and applies each individual test independently. So then you could actually pass them both at the same time. And so another way to think about the 12% test and how it applies to new districts is if you are already close to the limit and any new district would put you over the 12% test if you were just going to do one, then that wouldn't be allowed unless you did what's called a subtraction amendment. And so what that would allow you to do is to take away a parcel in your existing tax increment district. You can remove that, and so that it doesn't count towards the 12% because you've lowered the value of that district you already have. So any additional new districts that you create in the future would then be able to fit within the 12% test. And so when you do a subtraction amendment, it's important to think through a couple of different things. Like one, you have to subtract a full parcel. There's no mechanism in which you can just ascribe a lower value to one parcel and say, I want to keep the whole parcel in, but I only want to attribute half of the value to the parcel. I only want to get rid of half. They don't allow that. A district itself is made up of whole parcels. And in order to do an effective subtraction, you need to take out at least one whole parcel. There's no way to just cut it in half just for the purpose of a subtraction. And then secondly, the district that remains must be contiguous. So think of it this way. If you had a district that had 3 parcels, a northern, a central, and a southern district, you can't cut out only the central district, leaving a northern district and a northern parcel and a southern parcel that don't touch. So any parcels have to be able to touch on all sides. You should be able to connect them all through a line or some other way, shape, or form. You can pick out select parcels to leave holes in the district as long as there's a way to get all the way around. So your district can look like a donut shape with a hole in the middle. That's okay. But it can't be cut entirely in half with a gigantic chunk missing in the middle that doesn't allow you to connect from a top to the bottom. And then once you have a district, you can only do 4 boundary amendments generally throughout the life of the district. And a subtraction amendment would count as one of those 4 allowed boundary amendments, so leaving you only with 3. It's probably pretty unlikely that over the course of a district's life, you're going to need to amend it more than that, but it's just something to understand and keep in your back pocket when you're managing your districts over the life. And then an important factor when you're doing a subtraction amendment is that it's really like a future planning tool. If you know that sometime down the line, you want to make the conditions for a new district possible, it's a good way to do it because if you do earlier in the year, those values, the subtracted value does not get reflected until the state does its evaluation and updates the TID values, and that happens in August. So it's a way to think forward. And if you know that you can wait a while to create your new TID, then you would do the subtraction alone amendment. And then the other important thing to factor in when you're going to take value out of the district, of a tax increment district, that value then goes back into your general property tax base. So that's great. So all the other needs that you have in your community now get a little bit of a bump because that value that used to be in your tax increment district is now going back to pay for things in your general fund. So that is good. But the tricky thing is to remember that since it's not going to be in your tax increment district anymore, you're not going to get tax increment revenues to fund your projects in your current district. So if your district is successful, you've probably already taken out and done some borrowing for infrastructure costs related to streets or water or sewer or something like that. And now that you don't have that parcel in that district, it won't be able to contribute revenues to pay back the debt service of those projects. So this is just something to be aware of when you are doing subtraction amendments to make sure that it still works out for your cash flow of your existing district. Okay, so we've covered quickly creation of a new district and what that means for the 12% test, and then an individual subtraction. And as I mentioned, the subtraction works if you're able to plan farther out into the future. But if you need to do a subtraction in order to create a new district right now, what the state, this is a mechanism where you can do them both at the same time. And it's a bit more labor intensive because you're going to be doing two different things at the same time. But the state does allow a process to make that happen. It doesn't need to wait until August until you get that value all the way back. But of course, because the Department of Revenue is designing these strategies to make sure that it fits within their existing policies of the 12% test, it's not as simple as just using the current assessed values that are easy to access at the county level. What the Department of Revenue would like you to do to demonstrate compliance with the 12% test is to get independent third-party appraisals to go ahead and understand the value that's there. And in my conversations with DOR, the reason that they want you to take that additional step is because they need to get the most accurate real-time information of those values when you're trying to create the new district and subtract at the same time to make sure that you're still compliant with the 12% test. If you rely on the normal assessment process and the information that's available at the county, that might not be 100% accurate right now. And so what they want to do is, if you're going to go through this process, go ahead and get those independent evaluations and those appraisals to make sure that they have the most up-to-date information possible to comply with the 12% test. And so just a couple of things to think through as you're doing that. The appraised value that you get back has a pretty good likelihood to be higher than the taxable value that you got there. So this is going to imply some thinking about, and more detailed thinking about which parcels you can include or subtract from your previous district. That's going to change the math. And so it's important to know what all of your options are and to include enough parcels so that you're able to maybe mix and match some, because the assumptions that are there are going to change based on the information you get back from your appraisal. And all that process can take additional time. So you want to be able to cut it in a way that it gives you various options and leaves you with a plan B in case the values didn't come out the way that you thought they might. I've had experiences before where the values of the parcels that we wanted to take out wound up not being high enough to get past the 12% test for the new parcels that are the new district that we wanted to create. So then we had to go back and get additional appraisals for different parcels to make sure that we were meeting the right mix in order to achieve our goals. And so just the process that I described right there is another thing to keep in mind, because it's always going to take time. If you're going to be doing a subtraction and a creation, all the mixes of variables are going to have to change the strategy you do, and the additional thinking around that is going to take more time, one. And two, since you're relying on a third-party appraiser to do some work for you, you can't do it all in-house, you're going to have to rely on someone else to do that work, which is going to take additional time. So if, after today, you learn that this is an option for you and something that you want to pursue in your community, you're going to have to find an appraiser to do the work. That's going to take time. As soon as that person agrees to work with you, they're going to have to put it on their schedule. That takes time itself. Then they're going to have to go out and do the appraisal, write the report, and get that back to you, and that's going to take some time as well. And all those different things I mentioned are probably going to take a few weeks at least. So the last bit of advice is to make sure that you've got plenty of lead time to go ahead and do this work, because it's really not the kind of thing that can be done really on the spur of the moment. It's going to take a bit of a heavy lift to complete 2 new project plans, get the appraisal work done, communicate with DOR, all of these expectations. Just make sure to give yourself plenty of time when you're working. Okay, quickly, I wanted to talk about environmental remediation TIDs. An ER-TID is a bit of a tongue twister, but it can be very helpful if you have conditions in your community that need to be cleaned up. If, say, you have contaminated soil or water or conditions there that really need to be remediated for development to occur there. It's a very helpful method of paying funding for some of that work. It can fund the actual remediation itself, or it can pay for studies and other things that really support cleaning up the environment in your community. And one way that this is factored into the 12% test is that if you have multiple districts, you can actually exclude one of your environmental remediation TIDs from the 12% limit. So then you can still allow you to create other traditional economic development related TIDs in your community. But when you do an environmental remediation TID, the DNR, Department of Natural Resources, doesn't just allow you to do whatever you want. They're going to, of course, require some documentation and certification of the site prior to creation. They don't want you to say that, oh, we're going to call this an environmental remediation TID, but in reality, it's going to wind up being a commercial or residential project here. So they're, of course, going to want you to substantiate your claims there. And so that's an important thing to keep in mind. And so we can go to the next slide, please. All right, special legislation. So we talked about the 12% test, and you can, for most communities, it's not going to be a problem. But if for whatever reason you're already above 12 and you're tipped out, maybe you would like an exception to that, right? That's probably a pretty rare circumstance, but sometimes it may happen. The only way to really get around the 12% test, other than ways that we've already demonstrated, is to get special legislation. And so anytime the state is looking to grant a special exemption or a waiver for one unique circumstance, that's a pretty high bar, and it doesn't happen easily. So you really want to start very, very early and set your expectations accordingly to understand this could be a long lead time to make that happen, right? Individual waivers usually are tough to come, so just something to keep in mind. And when you're doing it, you really want to think about how can we make a really broad coalition and make a very strong statement about how important this really is and how valuable it's going to be for your community. And that's how you're going to make a great case for someone to make an exception for you. And the best way to really do that is to get a broad base of support and really develop a broad coalition of people who want to support you. So you really want to reach out to the other taxing jurisdictions in your community. If that's the school district, if that is your tech college or the county that you work with, make sure to bring together all of these people and absolutely start with your local legislators who are going to carry the ball for you down at the state capitol. They are really the ones who are going to drive this and move this forward, working with their colleagues down there. So really the key to making a very strong case is bringing together all the different people. So you're not just asking for yourself, but there are many, many people that this is going to touch and benefit a wide swath of your community. So just understand that it's a difficult process and your chances are going to be slim, but it's not never. But you should expect a long process to make this happen. And with that, I think we'll turn it over to Sean to talk about maximizing your tax increment development strategies. So you can hit the next slide, please.
Thank you, Josh. And again, good morning to everyone who's participating today. Josh covered a lot around the 12% test and its impacts and limitations and strategies you can use. My portion of the presentation is really focused around probably the two most important dates during the life of a tax increment district. the end of the life and the end of the expenditure period. To start out with this slide, I'm going to talk a little bit about the end of the life of the district, and then the rest of the presentation will be more around strategies as you get close to that end of the expenditure period point. So to start out with, the purpose of creating a district, Josh alluded to this earlier, is in the long run, your community wants to benefit from it, as well as the other taxing jurisdictions. And so understanding what the impact is when you close the district is very important in understanding whether that's the best decision for your community, in particular if you have a very successful district. So when you look at it, and we would certainly, if you were coming up upon your termination date for your district, we would recommend probably 2 years before that date, you really begin to analyze what benefits can the community achieve when and if this district is going to be closed. And those benefits can be tax relief to the citizens or levy limit flexibility that you maybe haven't had in the past. And we encounter a lot of our clients, a lot of our communities hold off on major initiatives, whether that be a new facility or a new reinvigorated street improvement program, until a successful tax increment district closes, using the strategy that those new expenses are now spread over the tax base of the community with the tax base that was formerly captured in the tax increment district. So those options to understand what you want to do at the point the district is going to close are very important to understand, so you don't miss an opportunity to do what you are trying to get done for your community and do it in the most economical way possible. Another very common end of life of the TID discussion that we're having with many of our clients right now is around the use of the affordable housing extension, which is a provision in the tax increment law that allows you to keep a district open 1 additional year after you have paid off the expenses of a particular district or it's reached its maximum life, for the purpose of funding an affordable housing fund in your community. So just as a brief example, if you have a tax increment district, a successful one that's generating $1 million a year in tax increment revenue, and you've reached the point of the end of the life of the tax increment district, you would have the ability to, through approval by the local governmental board or council, this does not require JRB approval at this point, Joint Review Board approval, you would have the ability to keep the district open for 1 more additional year and use those funds to put into a affordable housing fund that can be used anywhere in the community, not just in the area of the tax increment district from which the money is coming. So these analyses are very important for your community to spend time on, and you'll probably get this as a theme through our discussion today. Constant review and giving yourself enough lead time is very, very important in making sure you understand what your options are and are able to take advantage of those. The other areas I'm going to focus on in the coming slides, though, really have more to do as you approach the end of the expenditure period of your district, and will have to do with whether you want to add additional projects in the district, either within the boundaries of the district or within a half mile of the district, or whether you may want to consider sharing revenues from a successful district with either a challenge district or a potentially maybe a new district. So those are the areas more focused around making decisions and understanding your options around the end of the expenditure period of your particular tax increment district. Okay, so if we can move to the next one. One important thing to understand about the end of the expenditure period is what constitute an expense at that end of the period. Now, what is that end of the expenditure period definitionally? It's 5 years before the unextended maximum life of your tax increment district. And one thing, if you do extensions either through in the past using the distressed or severely distressed, or some of the other extensions I'll talk about here shortly, remember they extend the collection period of revenues for your tax increment district. They do not extend the expenditure period. So that expenditure period ends 5 years before the unextended maximum life. On a 20-year district, year 15. On a 27-year district, year 22. And when you reach that expenditure period, you can complete existing projects, but you cannot start new improvements once you've reached that date. So you may ask, well, what is definitionally an existing project? There's a couple things that have to be in place to define an existing project. First is it needs to be documented in your project plan, in your approved project plan by your governing body and by the Joint Review Board. And secondly, some other elements need to be in place. Either the project has physically begun, say a new street, a sewer project, water project, something like that, or you've established financing for the project, or you've signed a contract or a development agreement. So let me give you an example of how this might come into play. If the end of your expenditure period is July 1, and you have a situation where early this year, it's July 1 of 2021, earlier this year, a business came to you and said, we would like to build our new facility in your tax increment district, but we're going to need assistance to do so. And through the discussions, they request that over the remaining life of the TID, the 5 years, that they're going to need to get $1 million in revenue. Now let's say $500,000 in revenue from the tax increment district, and they're comfortable to receive that $500,000 over time. They don't need it up front, but they want to get it from the new tax revenue that they generate. In an instance like that, what you would need to do is you would need to get that development agreement completed that defines this existing project in order to be able to use the tax increment district in the years following the end of the expenditure period to pay for that incentive, that $500,000 incentive that I'm describing. So that development agreement would need to be signed and approved prior to the end of the expenditure period, but the actual payments being made to the business would occur after the expenditure period has come and gone. Okay, so if we could move to the next slide. Now, as I'd mentioned at the beginning, communities are trying to be more and more creative with leveraging their tax increment districts, their successful tax increment districts, to do projects that they need to find funding sources for, particularly in a levy limit environment, which can make things quite challenging. A number of years back, the state added half-mile projects as eligible projects in tax increment districts or with your tax increment district. And there was a couple of requirements in order to make that happen. One of those is that the half-mile project must be within the project plan, and it must be what is typically defined as an eligible project within the boundaries of the tax increment district. So if you have it in the plan and it's an eligible project cost under the TIF law for expenses that you would incur in your district, you can put those types of expenditures in the plan for projects that are outside of the district. Now, in some instances, depending on when your district was originally created, you may need to do an amendment to the district, and it would be a project plan amendment in order to make this happen. And if you have a tax increment district that was created before half-mile projects were added to the tax increment law, obviously your plan didn't contemplate half-mile projects at that time. So in that instance, if you wanted to do a half-mile project or add a number of them to your plan, the process would be doing an amendment, going through the Plan Commission public hearing, involving the Joint Review Board, and ultimately getting their approval as well as the governing body of your community's approval. But that would allow you to add projects that would be potentially an additional street, or let's say you had an example where you have a blight elimination district and you've achieved a lot of the goals in the boundaries of your tax increment district of this blight elimination district, but you wanted to take care of some blighted sites that are outside of the boundaries of the district. In an instance like that, you could take that successful district and revenue from that district, acquire a site outside of the district but within a half-mile, demolish maybe a blighted building, clean up the site, and make it ready for development. And this can be done using these half-mile project type amendments in your plan. One other thing I'll mention, or two last things I'll mention about half-mile projects, is it is a project plan amendment, not a boundary amendment, if you do an amendment to add half-mile projects. Why is that important? It's important because the 12% test that Josh explained in detail for us this morning does not come into play. We don't have to pass that test to do that type of an amendment. And secondly, the other thing to remember is when you do a half-mile project, and using my example of the blighted site, if a business or a housing development goes on that blighted site and creates new tax value by constructing on the site, that value is not going to be taxed as part of the TIF. It's going to be taxed as all property outside of a tax increment district would be taxed, in that the revenue will go to the city's or village's general fund, the school district, the county, and the tech college right away. So you can't count on half-mile projects to generate revenue for your TIF, but they may be a selling point to the overlapping taxing jurisdictions if you need to do an amendment to get there, because they're going to benefit from increased taxable value if it's created on those half-mile projects immediately. Okay, Sue, if we could move on to the next slide. Now, another common thing to review as you get closer to the end of the expenditure period, or maybe earlier for your particular tax increment district, is whether it makes sense to consider donoring revenue from a successful district to a recipient district. And there are some requirements to be able to do that. First and foremost, if you want to do that type of an amendment and take advantage of that option under the tax increment law, you do have to make that decision and amend the plan of the donoring district prior to the end of the donoring district's expenditure period. So we've had instances and we've argued that maybe that isn't the way the state law reads, but the DOR feels that that is the correct interpretation. So it is important to remember to do those type of amendments before the end of the expenditure period. Another thing to remember, and all of this I should have said at the outset, is important for communities that have more than one district. So if you want to do and take advantage of revenue sharing, the donor district and the recipient district both need to be and have the same overlapping jurisdictions. So just as a brief example, if you're a community that you're in two counties and one of your TIDs is in county A and the other TID is in county B, you're not going to be able to use donoring in that situation. You have to have them both be in the same overlapping districts. And finally, you do need to get joint review board approval for this type of an amendment. Now, on the other side, the recipient district, you do not have to amend the recipient district's plan for it to be the beneficiary of revenue from a donor district. But not all existing tax increment districts can be recipient districts. There are eligibility requirements. The most common one we see currently is revenue sharing into districts that by definition are either created as blight districts or rehab and conservation districts. As an example of that, we tend to see more blight districts be in maybe a downtown or a more urban area of your community that over time buildings maybe have gotten obsolete or deteriorated. And those types of districts can often have a lot of challenges generating their own increment, because typically you'll have to take either get rid of old buildings, which will drop the base value or tap into your base value, and you'll have to use increment to cover that base before you actually get captured increment in your district. So those types of districts are often districts that can use donoring in order to help that cash flow situation to get oftentimes very expensive projects done to redevelop areas in your community. Another eligibility for being a recipient district is if in the past your district was declared distressed or severely distressed. Now you're no longer able to make those designations. We're past the sunset date of that particular TIF provision. But if you have a distressed or severely distressed district and you at the time didn't donor money right away when you made that designation from other districts, you would have that opportunity to amend an existing district and share into a distressed or severely distressed. And finally, for any type of districts, blight, mixed use, industrial, conservation subdivision, revenue sharing can be used into all those districts if they have project costs related to rehabilitating low-cost housing, remediating environmental contamination. So if you have those types of expenditures in your recipient district's project plan, the option of considering donoring would be there for you. Okay, thank you, Sue. There we go. Thank you. Now, another question that we're being asked in many cases, sometimes at the end of the life of a district, if there are expenditures that have not yet been paid, but just as often we're being asked about extension amendments or extension approvals as a district gets close to the end of the expenditure period. So I'll lay out a brief example to highlight the situation. When a district gets closer to the end of the expenditure period, there is a limited amount of time, 5 years, from that date to the end of the life of the district. And if you do get an attractive project that comes to you in your tax increment district, that you will have to have more time to be able to collect increment revenue from that project in order to pay back the expenses that are going to be necessary in order for the project to move forward in the first place. So whether that be infrastructure or an incentive, those type of expenditures. So if you have a very attractive project coming to you in year 14 of 15 on a mixed use district, let's say, and they say, well, here's what we need, and you contact Ellers and we work with you on a preliminary forecast of what they're talking about constructing and how much revenue that would generate through the rest of the life of your TIF. It may be that it's not going to work out in order to be able to pay those expenses all back before we reach the end of the maximum life of that particular district. So with situations like that, the state does give us a couple different extension options that we could consider to get 3 to 4 extra years, and mostly 3, sometimes 4 extra years in particular cases, using either the standard extension or the technical college extension. I'll spend a few minutes on both of these. Now, with the standard extension, you're looking at a situation where you need to put together documentation as to justifying the need to get those extra years. So in the example I was just talking about, working with Ellers, you'd put together cash flows that show, in order for us to fully repay this new project plus the existing expenditures of a particular district, we'll need not just the 5 years remaining in term on our existing district, but we're going to need another 1 to 3 years in order to fully repay all the costs, including this new project costs. And then with that as a backdrop, we can go through the potential standard extension to extend the district. And there's 2 ways to get it approved. One is to do an independent audit from a CPA. And under those situations, the Joint Review Board is required to grant you that extension. The other option, and I think probably the more common one, certainly in my experience, it's been the chosen option. You can put together the material, make your case to the Joint Review Board members, who are really the body that has to approve this. It's the Joint Review Board that has to approve this. And you can get that approval from them just directly, rather than requiring them to give you the approval by going through the independent audit. Now, the Tech College Amendment is a little bit different in that the trigger to show that you qualify for it is an analysis showing that when the state picked up more of tech college funding, and I think this was in the 2013-14 timeframe, as I recall, if you can show that your district lost revenue because of that choice by the state to pick up more funding for tech college budgets, because what happened is the mill rate in pretty much all tech college situations around the state went down, and thus tax increment districts' revenue streams went down by the state picking up more of that revenue. So if you can show that that has negatively impacted your tax increment district, you qualify for that amendment. And the one other caveat, though, they don't apply this to any district. They do say it has to be districts created before that law went into place, so that the trigger date is October 1st of 2014. But then your process, if once you document that there has been a negative impact to you because of the tech college law change in funding, then you do need to go to the Joint Review Board, either with an audit in hand or through your own internal analysis, and get their approval. With the audit, they would have to approve it, documenting the need. Otherwise, you can ask it directly of them through internal work that you've done and ask for their support of the extension. So we're seeing more and more of this. Again, as communities try to be as creative as they can with the use of tax increment, and these extensions sometimes can be very, very beneficial in getting projects completed. Again, I'll just reiterate again with extensions, it extends the collection term. It does not extend the expenditure period. Now, another option, creative option, I wanted to take the group through this morning is using an overlapping tax increment district. And I think this is best talked about in an example. Josh and I work with a community that had a mixed use district that for a number of years they had hoped would generate some residential development in the community. They successfully got some industrial development. They successfully got some commercial development in the district, but the residential development was a newly platted residential was a key component of what they had hoped to achieve with the district, hence the mixed use designation at the beginning. But as unfortunately was the case, the opportunity came forth to them as they got very close to the end of the expenditure period of that district. And they were being asked to put in the street, sewer, water, stormwater expenditures for this designated residential area in their tax increment district in order to move this residential development forward, which they desperately were trying to stimulate and incentivize. So when we looked at the costs that the engineers had put together to put those public infrastructure improvements in, and we looked at the term of the existing district and its ability to pay those costs back, it quickly became clear that we would not be able to do it with the existing district. We're getting very close to the end of the expenditure period for that district, and we just didn't have enough time to be able to cover those costs with the district, even with extensions of that district as well, just as we talked about on the last slide. So the concept came out of, given the high level of infrastructure costs that we had to prepare the site for this residential development, what if we charge some of those costs to the existing tax increment district, but then overlay that district with a new district which would also pay for some of those public infrastructure costs? We would use the increment revenue from the original district, from the commercial and industrial sites, to pay for the original district's share of these new public infrastructure. And we would pay for the new district's share with the homes that are expected to be constructed in this residential area. And the benefit of the overlapping district was, from the new homes, we weren't going to just collect the revenue through the life of the old district, but we got a fresh 20-year term to collect revenues from the overlapping district. And when we put the two together, the risk situation to the community of putting in those infrastructure costs went down significantly, because they were leveraging the old district, and now they were also getting a longer period of term to collect on the new overlapping district to pay for the total project cost. So that is a situation that wouldn't work for every TIF situation that comes up and every opportunity that you'll see for your particular district in your particular community. But we've seen this in a couple situations. Both of our offices have done this type of overlapping tax increment district situation. And it was one we thought we wanted to make communities aware of, so they don't give up on a project maybe before they've explored all potential options to get a project paid for and be able to move forward. Sue, if we go to the next slide. So we wanted to offer, because tax increment is a very, very popular topic, and we get, as municipal advisors, we get a lot of questions about tax increment, what we can do and how we can do it, and what's the best way to move forward. But before opening it up to questions of the group this morning, a couple things I wanted to leave you with just as key points for this session. And one is that we think it's really important that you are fully aware of your options regarding tax increment, and that can really best be achieved by being formal about reviewing the status of your districts. And under the current law, I think one of the best opportunities to do that is as you prep for your annual joint review board meetings. It makes a lot of sense for your community to internally talk about where your districts are at and what opportunities and what deadlines are coming up. So I think trying to get that on the calendar once a year, twice a year, every year, just reviewing these districts, understanding what important dates are coming up, expenditure period, closing dates, and what opportunities would you have to use the districts are very, very important. And it's something that we strongly encourage and definitely want to be a part of with the communities that we work with, and new communities as well. Highlighting that end of the expenditure period, that's the one, once you're past it, a lot of the opportunities are gone. So spending the time preparing well in advance of that expenditure period to understand your options, pros and cons of those options, makes a lot of sense and well worth your effort in allocating, I know, your time that's at a premium, but a real good use of time to do so. And as I talked about at the beginning, ultimately a district will close, and we're very big proponents of spending the time analyzing what you want to do at the point that district closes. Ehlers, one of our most popular tools that we work with communities on is financial management plans. And the timing of doing a detailed financial plan, a management plan around closing, particularly districts that have a lot of increment value, is a really good use of a community's time in order to best prepare yourself to take full advantage of that closing and use it to the maximum extent you can for the long-term success of your community. These are the type of areas where we work with many of our clients, and we want to do so with new clients as well. We're here as an extension of your staff to provide ideas and concepts, pros and cons, to lay out all we can for the decision makers to make the best decision possible on tax increment financing, as well as other financial matters that your community has to confront. So with that, I appreciate everyone's participation, and I think it would be good at this point probably to turn it over for questions from the group this morning.
Well, thanks, Sean and Josh, and we do have a number of questions. A number of them revolve around the 12% test, so I think we'll go through those first. So I'll pose these to one of you, but then certainly feel free to expound, whoever I've not directed the question to, and in some cases I may add a couple thoughts as well. So the most popular question we had is if in the process of submitting your newly created tax increment district to the Department of Revenue through the certification process, you thought you were going to be good, you were under the 12% test based on the best information available, but then in fact you weren't. What happens when you go, or when that circumstance occurs? And maybe I'll give that to you, Josh. Take a crack at first.
Yeah, the DOR will definitely let you subtract other parcels out that you had initially put in. So they're not going to hold you to the fire on that. It's not going to hurt the whole process. Yes. It doesn't show that my thing is on mute. The DOR will definitely allow you to back out of some of the parcels initially.
Sure, I think Josh is having a. Sean, can you hear Josh?
I can hear Josh, yes.
And Sue, you can hear him as well?
Todd, can you hear me?
Yes. Okay. Well,
I just want to talk to Sean. Ask Sean a question.
Go right ahead, Josh. It seemed like for a moment there you had an issue with your mute button, but I think.
Thanks, everyone. Thanks for bearing with us. Anyway, the Department of Revenue will allow you to back out of certain parcels that you'd already included if you wind up being above the 12% test. It's not a kind of thing that will make you throw out the entire process and start over. So I really recommend getting in contact with the Department of Revenue and really leaning on them to help you talk through the process. I think it's really important, particularly if you're new to this, to really work with them as partners. And my experience with them is that they're very helpful in helping you come up to a solution and telling you the process and allowing you to follow their direction. I think is really good because it confirms that you're doing the things that they're asking you to do. And so part of it is really being able to pull out specific parcels to allow you to get under that and just testing each one of your different options. So that might not always be possible depending on the mix of things that you're trying to add, but really having conversations with the Department of Revenue is important. So they're not going to make you completely throw away everything you've already done. It can be iterative if things wind up progressing that way and you're not in compliance now. They will try to do their best to help out your situation.
Any other thoughts on that one, Sean?
Yeah, I think the only other item I'd add to what Josh mentioned is I think there is a deadline though from DOR, and I believe it's as you get toward the end of the year. We had one that I think Josh alluded to earlier that was challenging, and so there isn't an endless term to try to solve this problem. So you if it exists, as Josh said, certainly get in contact with Ellers, get in contact with your with the state representatives and start putting together options to try to resolve the issue as quickly as possible.
And I would just add, obviously if it's a single parcel TID, you can't remove it. So, in cases where you do have a larger TID and you're going to be really close, it's often useful to come up with a sort of a contingency plan. So think about that ahead of time, because when DOR notifies you that you're over, you'll have a pretty short window to get back with them. So you've already thought about, this is the least priority parcel. It's not needed for, continuity and boundaries. I'll take that one out first, then I'll move to that next one. It's good to think through that just so you're prepared. The next question we have is, and I'll give this one to you, Sean, is, Josh talked about the process for being able to simultaneously subtract territory from a TID in order to get under the 12% test, thereby enabling you to simultaneously create a new TID. And the question is that also available for adding territory to an existing TID? In other words, can you use this simultaneous procedure to subtract territory from one TID and amend another, or is it only for creations?
Yeah, the limitation is on creations in that situation. So if you're looking to add territory, unfortunately, without some sort of special legislation, you wouldn't be able to get there. It's limited to new creations at this point.
And a question for you, Josh. So we talked about the subtraction process and the fact that it takes a cycle evaluation for that to basically wash out in the numbers and no longer be part of your TID NEV. What about closure of a district? So if I adopt a resolution to close a tax increment district, at what point does the incremental value in that TID stop counting against the test?
Yeah, fortunately, that's one that can be done pretty much immediately as soon as the governing body adopts a resolution to close the district. So that's one that can happen very quickly. If you really have all your ducks in a row, then you can actually close a district and at the same meeting open up the new one and have all that process flow through at one time. So if you're very prepared and you're able to do all those steps and put it all together, you can certainly save yourself some time and effort by putting all those in front of your governing body at the same time. That's a nice way to just get everyone's kind of head aligned with all of your strategies, so you don't have to spend time bringing more people on board and re-educating them. You can really spend that one meeting thinking about your holistic strategy for economic development in your community and just get it all done at one shot, thinking about the same thing and getting everyone on the same page.
Thank you. So the next question, Sean, you talked about the expenditure period for a tax increment district. And you had mentioned that these extensions extend the recovery period, but not the expenditure period itself. Is there a way to extend a district's expenditure period?
Yeah, the only way is one that Josh touched on at the end of his portion of today's discussion, which is that special legislation. You would need to get that. Some communities have, but it's not an easy process, as Josh pointed out. And I don't know if it would be. Todd, maybe you might remember. I think there's two that I can think of that are out there right now. One of them is the village of Lake Delton, and maybe is it Caledonia is the other one that got special legislation. But I really don't believe there's very many that have gotten that to extend expenditure periods.
Yeah, but you see it periodically, but you're absolutely correct. The only way you can accomplish it is through special legislation. So there are, in any given year, there may be a district or two where, that is requested. But, as was discussed, there's, that's a whole process unto itself. So if that's something that, is critical, you need to really be thinking about that early and engaging your legislators to gain support for that. The next question relates to project plan amendments. So we talked about territory amendments and then also about project plan amendments. And I'll put this one to you, Josh. Is there a limit on the number of project plan amendments, so those not involving territory, that can be approved?
Fortunately, no, there's not a limit to project plan amendments. So, when you set out your initial project plan, you've got a 20-year life of that district. So you don't have to have a perfectly clear crystal ball to see into the future of all the different ways that that district is going to need to develop over time. So they allow you to amend that as needed.
Thank you. Sean, you had talked about the ability to extend a district for one additional year for purposes of the affordable housing. And the question we have is, what basically what can you spend the money on? What are eligible expenditures as far as those funds?
Yeah, I think I alluded to it. First thing I'd say is I often get asked the question, can we only use it within the boundaries of the TIF? And I think I'd mentioned, no, you can use it throughout the community when you create that sort of fund. The statute is very open, other than to say 75% of it has to be used for affordable housing and the other 25% for the general housing. And it's the 75% is a minimum number. So you could use 100% of it for affordable housing if you would like. Now, what that use could be is where there's a lot of creativity. So there's certainly infrastructure to drive down the cost of housing, loans, grants. We've got in a few communities that actually own mobile home parks and fixing up the sites around those, given that in most cases they'll qualify as in the affordable housing range. That's another one that I've heard of. So there's a lot of options there. What I would suggest is that communities, when they're considering doing the year extension, that either as maybe the first use of the money or even before putting the extension is in place, they commission resources to try to understand what their community's housing situation is and how these dollars could be best put to use in order to really get a good forward-looking plan that they can share with the overlapping taxing jurisdictions and the community in general as to why they're recommending this extension to create this sort of a fund. The Joint Review Board does not get a vote on this, but because part of TIF is an ongoing relationship with the overlapping taxing jurisdictions, I think the more they understand why you're making the decisions and you can share that you're being very thoughtful about it, is a good way to go about your business.
One thing I would add is, when you extend the TIF, it's, as mentioned, a simple process. It's just a resolution, but that resolution does require you to provide a description of how you will use the money. So As Sean mentioned, you've got wide latitude, so it would behoove you to, be fairly broad in the description of how you may use those funds. I have a community I'm working with that very recently is electing to use, those dollars essentially in the form of a development incentive to affordable projects. So again, there's really no limit in the statute as to the exact form of the expenditure. But the thing that is important is that you are able to document the requirement that, at least again, 75% of the funds were spent on affordable housing, and then further having documentation that the individuals that are renting or purchasing the units that are created or rehabilitated meet the income requirements. Josh, we've got a question I'll send to you. It indicates that the submitter didn't realize there was different maximum lives for different types of districts. And so the question is why would you do a 20-year district if you could do a 27-year district?
Yeah, I think that when those are engaged for blight or distressed districts, what they're really saying is when the district is in trouble, they've shown financial difficulty. So that's why they're giving you the additional latitude to continue to collect increment for that time, because you've really gone through a process to establish that it's having trouble. So that's why they're allowed to do that. And that's a special designation that you get. So I don't believe that you can do that at the outset and just establish it on the front end. Sean, Todd, I don't know if you have any additional thoughts on that.
Yeah, a couple things I mentioned. So at the outset, if you're creating a new district, why would you not do a district that could be 27 years as compared to a district that would be limited to 20 years? One is you can't always make the designation of blight on property that you would need to make of 50% of the property anyway that you would be putting in your district in order to be able to create a 27-year blight elimination district. If you have a district that is primarily industrial, or at least 50% industrial, and you don't have, it's open property, let's say, that doesn't meet the blight definition that's in the tax increment law, those would be other reasons to direct you more toward the industrial and or mixed use type district. And finally, depending on what your long-term goals are, it may be that you don't want your district going 27 years because you're trying to get the tax base back to your other jurisdictions as well as your own general fund on a faster basis. But I think the biggest limitation is, can you make the required findings to the property to get that 27-year term?
Just to leverage off that last point quickly, Sean mentioned you might not always want 27 years for it. And I think to me, like the discussion around TIF is really just one of the interconnectedness of all these different districts, with sharing amendments and, going back to the general fund in which we close it. Each district, you started on its own with that own boundary and all the projects going into that, but you should always be thinking about how does this relate to all the other work that I want to do, not just in that specific district, but what is that going to preclude me from another option in the future? If I leave this open for longer, that means that, I'm freezing that property value for additional time that it could be going back to the general fund. So Sean mentioned earlier a couple times of how important it is to constantly be doing these kind of check-ins on your district once or twice a year and really formalize that process. It's because they connect and touch so many other parts of your community that you really want to be, poking at all the different assumptions that you can to make sure that you're not doing something that winds up harming you in the long run.
Thank you. We've got a few questions that are related to the half-mile radius. Sean, I'll send these over to you. So the next question is that half-mile boundary. How do you actually determine the half-mile? In other words, how do you figure out what's within a half mile and what isn't?
Yeah, a lot of communities, I'm far from an expert on mapping, but they have a tool that you can take the boundaries of your existing district and the map mapping program can go a half mile out from every edge of your existing district, all throughout around the boundaries of that existing district, to tell you where that half mile ends. So it's not half mile from, say, the middle of the district. It's a half mile from the edge of the district, all surrounding the district. Now, the one other limitation to half mile projects, though, and this is a very important limitation, is the property has to be within the corporate boundaries of your community. So you can't be doing projects going into, say, the township. That property would have to be annexed in to the community prior to you taking advantage and using the half mile provision in order to do a project located in property that was originally in the town and within a half mile, but through an annexation you brought into the community. So that's how those maps are drawn. That's how that area is defined.
Right. And so oftentimes you'll see that map, Sean talks about it, and it'll have the half mile radius, and you'll just see a big portion that's cut out where it extends beyond the municipal boundary.
Yep.
Another question related to the half mile provision is, so let's say I've got a well that I'm going to need to upgrade to provide more capacity to expand, do an expansion for a user that's in my manufacturing park that's part of a TID. So if I've got to make improvements to that well, but it's more than a half mile away, am I just out of luck there? I'll send that to you, Sean.
Yeah. So those types of project costs, utility improvements that benefit the tax increment district, even before the state added the ability to do half mile project costs, those types, so water, sewer, storm sewer, those types of project costs, if you can show benefit to your tax increment district, have always been eligible, even if they're outside the boundaries of the tax increment district, and even if they're outside the boundaries of the half mile location. So as an example, a water tower needs to be constructed on the highest point, right, in order to be effective. If that's outside of the district, outside a half mile, but is necessary for the district to get a business that needs that kind of water pressure, those types of expenses can be done and charged to the TID, and they've always been able to under the TIF law.
Right. As Sean noted, just a little bit of legislative history. Those provisions Sean just referenced, permitting utility projects, and it's very specific to sanitary, sewer, water system improvements, and stormwater management improvements. Those have always been eligible expenditures outside of boundaries since the inception of the TID law. So a lot of times it gets confusing because we had this subsequent legislation about a decade ago where they brought in the half mile projects. So it's always important to remember that half mile ability or limitation is only applicable to projects other than water, sewer, or stormwater. The next question we have, and this is also related to the half mile, so I will keep with you, Sean, on this. And I think you kind of addressed this, but we'll reiterate it here. So if you have, if you're contemplating undertaking a project within your half mile radius, is it acceptable to have projects that may deal with blight, but not increase the valuation, or could it even involve an exempt entity?
Yeah, I think it can. The important part is you're going to need to have that project in the plan and define such that the Joint Review Board has an opportunity to see that project is included and is a possibility. But yeah, I think you could move forward with if I understood everything about your question, Todd, with the type of project you're describing.
Yeah, and I think the important point that you mentioned earlier in the presentation is really regardless of whether it is a tax exempt parcel or a blighted parcel, you're not going to gain the value of the increment anyways. And maybe I think part of what the question was posed at is it okay to have a project cost that doesn't result in, new value being created, even if it's outside of a TID? And, obviously, the overall goal of TIF is to increase values, but certainly there are other types of project costs you might undertake within or without a TID or outside of a TID that are important for their own reasons, in terms of meeting the objectives of the project plan. For example, if you had some sort of a recreational facility or walkways that were important for connectivity in a downtown area, those aren't going to generate value, but they're still necessary and important for the implementation of your plan. So the next question has to do with within a project plan, a required statutory element is the economic feasibility study, and within that, we provide a forecast or a projection of when we anticipate the district may recover its project costs. So the question is, let's say, for example, our project plan forecasted that the district would be able to recover its project costs and close within 10 years. And now you've got a developer that comes in, near the end of that 10-year time frame and asks for incentives. And now you're going to have a longer payback, than that 10-year period. The question is, would you have to amend the project plan at that point because you were going to now say close in 15 years instead of 10? Josh, you want to try that one?
No, I mean, as long as you're still within your primary expenditure period, it doesn't need, if you're adding a new incentive, then yes, you'll have to go through a project plan amendment because that was not already included in the project plan. You can't just authorize new expenditures within that are outside of your original project plan. So that in itself would require the new amendment. Just because you're going to go from 10, which was expected to close the district early, to closing the district after 15 years, which is still early, you don't need to require a new amendment for that. But just to be clear that a new project cannot be done without a project plan amendment.
And I think that's the point of clarity. And, we get these questions all the time where, when you're planning for a 20 or a 27-year district, that's a long time. And it's, it's impossible in year one to understand what may change in year 5 or year 10. And so we get the question all the time, do I need to amend my project plan? So, as Josh stated, the mere fact that you are now going to close later than you thought you would doesn't in itself require an amendment. But if the cause of that delay or that extension to close is something that was completely unforeseen and new and not covered within the scope of the original plan, that definitely argues for an amendment. And there's not always a black and white response to that. A lot of times it's just based on the facts and the circumstances and an evaluation of the project plan. At Ellers, we try to write plans pretty broadly so that they can encompass those types of unforeseen scenarios. But again, you can't foresee everything. And if something really new comes out of the woodwork, and particularly a good example is if you didn't have development incentives in your original project plan, because there's also a requirement that appear specifically in the hearing notice, categorically you would not be able to offer a development incentive in that TID without amending the plan.
I think that for me, the point of the project plan is to really be a communications tool to your community and your residents there, so they know what this is being used for. So the reason you want to go ahead and do those project plan amendments is so that you can really effectively communicate that this is going to be something that we're doing here. So you don't wind up getting pushback from people who say, like, you never told us that you were going to do this thing and it's changing our community. And you can really demonstrate that, yes, we have, and it's gone through an appropriate process to make sure that that's an expenditure that everyone and all these taxing jurisdictions that you're partners with for the long run have bought off on an approved line.
So the next question relates to expenditure periods. I'll direct this to you, Sean. Is a PAYGO approved signed developers agreement considered spent when it's signed with relation to the expenditure period, even if the payments will be made after the expenditure period ends.
It is, yes. There was a time where there was a requirement that you needed to put that in a form of a bond, and we had tax increment revenue bonds, municipal revenue obligations outstanding in order to have that payment be considered a debt payment, which has always been able to be paid beyond the expenditure period. But the DOA's interpretation at this point is that if we've got a development agreement and we're going to make contractual payments from the tax increment after the expenditure period, that is sufficient to meet the existing project definition, and those payments can occur after the expenditure period.
Right. The key is you've contractually obligated yourself, so you've incurred the liability prior to the end of the district. Sean, another one for you here, and I think we may have touched on this already in the prior question, but the question here is, with regard to this discussion of utility water, sewer, storm projects being eligible, aside from or outside of even the half mile. What if they're outside of the municipal boundaries? The example here is many wells in our community are owned by us, but located outside of the municipal boundaries.
Yeah, it's just when you're using that half mile provision as your justification to pay for an expenditure, those costs have to be within the corporate boundaries. If you're doing a utility project that is already allowable outside the boundaries of the TID, that will be located where it makes the most engineering sense for it to be located, and you would be able to charge that expense to your tax increment district.
Thank you, Sean. So I've saved this question for last because I think it's a great question. So I'm just going to throw it out there, and we'll tackle it here together. So the question is, can you talk about keeping a TID open, but working with the school district to give them their cut of when the district will close before the closure date? Any takers? I've actually run into this, so I'm happy to start this off.
Yeah, I'll see you guys on that one. Let's see what you guys come up with.
Yeah,
go ahead, Todd. I've got a few thoughts on it too, but yeah.
Sure. We'll see if we come to the same conclusion here. So, under statute, at the time the district closes, either because you've terminated it or because it's reached the expiry of its maximum life, you're obligated to take whatever funds remain in that TID fund after all liabilities have been accounted for and satisfied, and you've got to pay those residual dollars back out to the taxing jurisdiction, essentially in the same pro rata share as they come in. So you would normally look at your statement of taxes or your Form PC 202 and just disseminate the dollars on that same percentage. So, the idea here is that the school district comes to you and says, hey, I know this district is going to close in 5 years. We want our cash now. So there's no provision in the statute that specifically authorizes or permits a taxing jurisdiction to make that request. I have seen it done, or at least contemplated. And, number one, I think the municipality would just be simply doing this out of cooperation and willingness to do so. But really, the municipality is the one that's going to be assuming the risk with this, because it would have to be done on a forecasted basis, and we know that sometimes valuations do screwy things we don't anticipate. Tax rates change more than we expected up or down, and so if you calculated 5 years hence that the school district share was going to be $500,000, number one, you'd have to have the cash to make the payment. So assuming you had that cash and were willing to turn it over, what you would really be doing then is just keeping what would otherwise be the school district share at the end. And if those, numbers don't line up exactly, so if, at the end, the school district share was only 480 and you gave them 5, you're going to be 20,000 in the hole unless you had some form of an agreement to, to make that whole at the end. I've seen it at least contemplated, but that would be my thoughts on that sort of a scenario.
Yeah, the one I've run into is a little bit different than that, and deals with the affordable housing provision. So with the affordable housing provision, there's really 2 ways you can use that. One is to, in the last year where you've calculated you will have money to pay off all of your TID expenses, you can do that and then use the net amount after you've paid off your expenses to fund the affordable housing fund, as long as that amount isn't greater than what you collected in that particular year. So the state, you don't necessarily have to go to the next year following paying off your revenue, your last expenses on a TID for the collection in the affordable housing for the affordable housing fund. And I have run into a situation where the overlapping jurisdictions made it clear to a community that they wanted to get a distribution after they made the final expenditures and paid everything back in that particular year. They were fine with the next year, the community collecting 100% of that increment and putting it in an affordable housing fund. But they made it clear that they didn't have a vote on it per se, but they made clear to the community that what they wanted to see happen was, in the final year where costs were being paid back regarding the TID, after those costs were being paid, they wanted to see a distribution to themselves, each of the individual overlapping districts. And then the next year, the community could take that money and put all of it into the affordable housing fund. So I haven't gotten the exact same question that you went through, Todd, but I think it's important, big picture wise, just to keep communicating with the other taxing jurisdictions so that you can get their feedback. Because remember, you might be doing another TID 2, 3, 4 years out, and it's good to keep that positive working relationship.
Yeah, that's a good point. There's always what you can do, and then there's always what you can do and still maintain good relationships with the other taxing entities who truly are your partners in this important economic development tool. Well, we've gotten through all the questions, gentlemen, so congratulations, and I'm going to wrap us up now. So that's all we have for you today. I want to thank both Sean and Josh for their insights, and thanks to all of you for taking time out of your busy day to join us. A copy of this presentation, as well as a recording of the session, will be posted to your virtual attendee hub for future reference. We're always interested in learning how we can make your virtual experience more dynamic and deliver content that is most valuable to you, and would ask that you fill out a very brief survey for us. You can do this in one of 2 ways. On the right-hand side of your screen, there is a survey button under the chat and Q&A buttons. You can click on that survey button right now to take the survey. But if you don't have time today, you will receive an email with a link to take the survey tomorrow afternoon. We do hope you'll take the time to give us your thoughts on what we did well and where we can do better. Please consider joining us on May 19th for a state biennial budget and legislative update from our friends from the League of Wisconsin Municipalities. Thanks again for attending, and enjoy the rest of your day.
Great. Thanks so much.
Thanks, everybody. Appreciate it.
Bye now.
Bye-bye.